It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital, and sitting in to the podcast today, Michael Becker.
Hey, Paul.
Smartest guy in the room, Dr. Becker. We should be calling him that.
I did go to college for 8 years, but I'm not a doctor, so I don't know if I should put that on the podcast, but I had a good time.
Perhaps you should not put that on the podcast.
I'm sure my parents weren't very happy with me along the way, but
Michael,
it's good. Growth opportunities.
That's right. Michael, who owns over 5,200 apartment units in the Dallas-Fort Worth area, is a former banker with one of the largest national banks, and now is gone from a loaner to an owner with his group SPI. So he is an expert in multifamily. Sitting in the podcast today, we don't want to forget James Zhang. He is with Old Capital. James, how are you?
Great. Thanks for having me, Paul.
2 weeks in a row. Look at that.
It's amazing. Well, he just came back from a property, and I wanted to get him on because we got a question that came in, so I'm going to have him ask that in a second. But Michael, what's going on in Old Capital?
We'll beat the drum once again. We have almost upon us the next Old Capital Speaker Series, March 28th, Grapevine Convention Center near DFW Airport. The funniest economist on earth, Dr. Mark Dotzauer, will come out and give an entertaining speech about what's going on in the world, national, and Texas economies, and how the heck does that apply to apartment investors. So that'll be good. And then getting ever so closer, still several months out, but the next second annual Old Capital Conference at the AT&T Stadium where the Cowboys play. Should be a phenomenal event. Expecting over 700 people. You can find that information and sign up for both the speaker series, which is free to you and expensive to Paul. So I'll certainly take him up on his generosity. And certainly which we will charge for is the Old Capital Conference. So both those can you sign up at oldcapitalpodcast.com. That's www.oldcapitalpodcast.com. There you can sign up for those. We're starting out a little lower pricing, and we will be raising our pricing as we get more people sign up and get closer to the event. So please save yourselves a few bucks. It certainly helps us to know how many people to plan for if you guys sign up early. So if you're going to go, you know you're going to go. Save yourself some dollars and please help the good guys out on planning for the conference here.
So James just came in from a property, and he just happened to be talking about this, and we had a question that came in at the same time in the last day or two. So I want to have James ask the question, and let's get it going.
Sure, Mike. So I was at a property, and the listing broker had two prices for a deal. So one was new debt, and one was for an assumption with a possible supplemental. And so the buyer I was walking with wanted us to run it both ways and sort of figure out which way they should present the offer. And so when you're looking at deals, how are you evaluating those two different options?
Yeah, that is certainly something that has been top of my mind a lot as we're looking through these deals. So some quick stats. Last year, I'm thinking, so in 2016, I bought 8 properties, and I believe one was a loan assumption, and the other 7 were free and clear. And then in 2017, I kind of, as the rates rose right after the election, we've kind of had the opposite. We bought 5 properties. We didn't buy quite as many, but 4 of those are loan assumptions and 1 was free and clear. So we kind of took the opposite approach. And then kind of going forward, that's the more and more, I think the loan assumptions are becoming more attractive than the new debt for a couple of reasons. So really when you're looking at it, like James alluded to, the broker that was telling him about that specific property said the price is X, and then for free and clear, and the price is X minus a prepayment penalty for the cash to note or the loan assumption. So you know the pros, and obviously, so kind of go through the pros and the cons. So the pros of going the loan assumption route is you'll get a basis break. So you get, in certain cases, several $100,000 in basis breaks up to, millions of dollars in a basis break, because that's how large these prepayment penalties can be, depending on the note rate and the length of term relative to, just kind of the yield maintenance calculation, basically. So that is certainly one of the pros. So you certainly can get into that. And then I'm having, a predetermined interest rate on the first mortgage. And then, certainly if you get a supplemental, that is kind of determined by market. But if that first mortgage is in the low to mid 4s, that would be lower than what the current market rates are as we record this in February of 2018. So you can potentially get the bulk of your debt at a lower interest rate. So that certainly saves on your interest expense. So those are the primary pros of going that way. Kind of the flip side of it, the cons of going to the loan assumption versus new debt is a new debt anymore. You're getting 2, 3, 4, 5 years of interest only on the new debt. So which when you're assuming a mortgage, you really only have what is left on the primary term, and that is what you get for your IO period. So most of the loans that were put on 2-3 years ago were, getting 1 to 3 years of IO. So most loan assumptions will have little to no interest only, and then the supplemental financing, typically almost 100% time is always amortizing out of the gate. So that's really kind of the biggest difference between the two, and then really kind of just matching whatever the current market rates are. And you compare that relative to the supplemental financing. But, more and more as these rates have risen, as we haven't seen a whole lot of stuff transact since the rates have popped over the last couple of months, your cap rate and your note interest rate are pretty close to each other in a lot of scenarios that we're seeing, at least I'm looking at as a buyer, or James and Paul are looking at as lenders. So a lot of these deals are getting debt service constrained. So you're not able to get all the way up to the full 80% leverage or even 75 in a lot of cases, depending on the quality of the asset, like you were able to, a year to 5+ years ago. So I don't know if either Paul or James, you guys have anything to add from like kind of what you're seeing when you're quoting deals and deals getting debt service constrained, or kind of just what's kind of live commentary from the marketplace right now?
Yes, I mean, there's probably 30 deals out on the market here in DFW, and on the Whisper prices, most of the debt is closer to 75% loan to cost.
And this is in the C space.
C space, yeah. B space, you're probably closer to 70-75% loan to cost on deals. And so with interest rates, looking 4.75 to 5 to 5.25, depending on the size of the loan and whether it's qualifying for green, I mean, just rents haven't grown fast enough to compensate based on the Whisper prices. So the property I was just at, I mean, the listing broker was, the way they're underwriting deals, they don't know if everyone's going to hit their Whisper. I mean, it's Dallas and everybody has loved DFW. And so there's going to be a lot of bidders. It's just, I don't know if the prices are going to be at the Whispers that people think it's going to be at.
Yeah, that's going to be the interesting thing. Like I said, we just had a bunch of deals roll out late January, and we're in the middle of February right now as we record this. So there's going to be some period of price discovery, I think, that everyone's going to kind of figure out, okay, so the buyers are expecting certain pricing because of the most recent 6 months of trades have all been at these cap rates and this kind of general price per pound. And then the buyers are going to come in with some new fresh debt quotes which reflect the higher interest rates. And then we'll see who capitulates, either the buyers or the sellers on price. So if the buyers are willing to accept lower returns, and we're going to keep going on with these high prices. If not, then there'll be a point at where several deals don't actually trade, and then the pricing might adjust.
And my advice to a lot of buyers was, I'm okay overpaying if the location and the quality asset is there, but you shouldn't be pushing in the rough neighborhoods at this point in the game.
Right.
Yeah.
What is debt service coverage constraint, James? What does that mean? And if I had gotten a term sheet that said that it was good at 20% down when the rates were at 4.54.
Sure.
And now rates are at 5.25. 80% now is 72%.
Right. So I mean, this
does that work?
this caught a lot of people who went under contract in November and December. Is the lender is really looking at your NOI divided by your debt service, and they're looking for a 125 coverage. So
meaning the NOI is 125% of your P&I payment, correct?
That's right. The NOI didn't move from December to January significantly, but interest rates went up 30 to 40 basis points. So that bottom number that you're dividing by the debt service increased, and your NOI stayed the same essentially. And in some properties, the NOI went down because the net rental in December and January typically isn't as high. So a lot of loans are being cut to anywhere from 75 to 77%, I think, on the last 2 or 3 deals that we did. So we try to make it up in underwriting, but if the net rental's not there and the debt service isn't there, then, or the interest rate increasing so much in such a short amount of time, it's hard for properties to sustain that high of leverage.
So the playbook is cut loan proceeds, right? Bring more equity, lower loan.
That's if necessary. I mean, I think when people are underwriting these deals, we've seen interest rates come up so fast that when you're underwriting these deals, I mean, using 4.5 or 4.75, that used to be safe, but now we're probably 5 to 5.25. So it's just more difficult to get to full leverage on deals.
So, Paul, looking around this table here, I do have some gray, but James is younger than me, and I was in junior high school last time we had a major recession in the 80s, and then I was a young banker in the last recession, right? Kind of the front end of my career, my early 30s, and so you got a little bit more wisdom than Paul. I'm not calling you old. I'm just saying you're a little bit more wise than James and I here. Maybe give everyone a real brief history lesson here. So the 70s were in 70s and early 80s. We had extremely high double-digit interest rates. Obviously, you weren't professionally active at that point, but you became professionally active in the late 80s, kind of one of the worst times here. So kind of maybe talk through what did you observe through those times, and maybe
I would say closer to the middle 80s.
Yeah, what are some lessons? History doesn't necessarily repeat itself, but it certainly rhymes. What are some things that kind of are top of your mind that you want people to kind of pay attention to as we potentially come in a inflationary and rising interest rate environment?
Well, I would just say any interest rate that is in a single digit is a good interest rate. So I've did transactions for people that were buying real estate back in the mid 80s when interest rates in the late 80s became 11, 12%. And there were still transactions that traded. You just had to make a financial decision whether you're going to go forward in the transaction or not. But last time is not like this time, as an example. A lot of the transactions before had the short maturities. These have long maturities to them, that in case any time that interest rates were to rise in the environment, you want to hold on to these mortgages like they're life preservers, and you just want to stay into as long as possible. How you stay alive is operating the property more efficiently than you did before. I mean, you always want to make your mortgage payment, stay in the property. You may not be paying dividends or cash out to your investors, but you're not asking for cash calls to come in. You want to stay ahead of where rents are going to be declining. So you want to be on the front side because rents are like fish, because if someone moves out, you want to be able to reduce the rent as quickly as possible, because that space will remain empty for the entire month if you don't do that. So be on the front end on something like that in terms of just staying active and paying attention about what you're doing. I talked with a guy the other day that bought a property 10 years ago up in Oklahoma City. I said, and the property was in terrible shape. This guy is a rich guy, but I said, when was the last time you were at the property? Take a look at it. When I bought it 10 years ago. So my advice is don't neglect your properties during this period of time if interest rates are rising. Again, single digits, even up for 5, 6, 7 deals will still trade. I mean,
but potentially, right? So if people set their business up right, this is kind of what my thought process is. Maybe you can give a quick comment, because I know we're running long on a Mike Monday here, but if you're able to, say, buy a deal, say in 2017 or even today, you buy a deal and the rates are in the mid 4s, or now it might be 5%. Mm-hmm. I mean, take a 12-year term on it and rates go, up 6, 7, 8%. Who knows where they're going to go? That is generally a sign that we have inflation. So Absolutely. People are going to have a harder time buying homes because the rates are up. So the qualifying are going to be more difficult, and that should be putting upward pressure on rental rates at the same time, right? So if you get your cost of capital fixed by having, a 10, 12-year loan on this deal, and you're in the mid 4s or 5%, and then rents keep going up, in theory, you should make more money along the way, right?
I definitely agree with that. I remember last time when we had, right before the whole thing collapsed, it was cheaper to buy a house than to rent an apartment building. Because when you bought a house, you could do it at 100% or 107 or 125% leverage in the deal. You may have found a car in the garage too. So there's all different tricks that went on. But today we underwrite these deals very strongly. We take a look at the quality of not only the asset, but of the borrower too. Who are we lending this money to? Because I always say that in these transactions, I have limited upside in these deals. I may make 5% of a rate of return on these deals, but I have unlimited downside in these deals. So, that may mean that you do not operate the property efficiently. The property goes bad, and now I have to come and fix and cure as the lender in this deal. So keep the property going.
Yeah. So put money in your deals. Don't starve them.
That's right.
Treat your property right. I'll treat you well as well.
Absolutely.
So, cool. So what else we got going on, Paul? We mentioned the 2 conferences, right?
We mentioned the 2 conferences. One of the things that I do want to mention too is that if anybody wanted to get a better relationship with Michael, what's the best way of somebody understand a little bit about what you do?
Yeah, the easiest way to find more information about my company, SPI Advisory, and myself is really just go to our website, which is www.spiadvisory.com. That's SPI like spy. advisor.com. On there, there's a contact us page, and you fill the form out. I'm always happy to have a 10 or 15 minute telephone call with listeners of the podcast if they want to find out more information about what we do at SPI and how we can work together.
That sounds great. James, thanks for hanging with us in the podcast this week. Week number 2, fantastic.
Great. Thanks, Paul.
Got to do more of these with James.
We always enjoy James. All right, Michael, have a great day. I'm Paul Peebles.